Well, thanks for joining us for another Everyday Trader. We took a break off last week because we had a lot going on. We were in Las Vegas for a summit with some of our clients at Options Animal. This is Eric Hale, by the way, and with me is Greg.
Pleasure. Hopefully everyone's doing well.
Did you have a good time in Vegas?
Vegas was good. It was good to be back in person again. I think for me, one of the biggest things that I missed with COVID, like I know a lot of us have, is just interacting with people and seeing that people are real, and just recognizing. I know there was one time we were standing around with a handful of other people in a casino, and the student who was next to me, and I apologize, I don't remember who you were, so please send me a note. You can even leave it here in the chat bar if you want, if you're listening to Everyday Trader.
Wait, was it the Darth guy, the guy playing the dark side?
No. The guy that was standing next to me with the ponytail. He's a professor. He's a psychology professor.
Okay. Yeah, that's Kim.
Kim, that's right. So Kim leaned over to me, he's like, look around. He's like, nobody's staring at their phones. He's like, and we're all interacting and we're having a good time. He's like, this is awesome. He's like, we need to get back to this. We've gotten so addicted to these things right here. He said in his classes he teaches, he's like, I teach lectures, and he's like, everybody's they're staring at their phone the whole time, and it's just, it was refreshing to be back.
Yeah, it was really good to be back in person, to see all of our friends and clients, and yes, I really needed that. We were going too long, so hopefully we get back into a regular cadence of doing that again.
So yeah, it was good.
Yeah. A lot of good content, a lot of interesting stuff. Rolled out some big features with Trader Oasis. So we'll talk more about that in this channel, but we wanted to focus on two important issues today. We had two significant reports this week. The first, of course, being the CPI, and then the FOMC meeting today. So I wanted to share, let me share the screen over here. So here's the BLS report and consumer price index, which is a big deal because it's ostensibly what the Fed is basing their projections on. We'll talk a little bit about that. The number came in really, really good, lower than most people expected. I break down and look at some of the key components here. On the right, we have last month's. Now, the yellowish orange bars are the importance weighting. I don't know if you see my screen? Is my screen being shared?
Yep.
So the blue line is the change in inflation. So the biggest component last month, rent of shelter, cost of living was the highest. It went up 0.7, and it surprised people this quarter or this month by coming down to 6. Medical services down, but look at some of these other big numbers too that were significant in transportation services, gasoline, used cars and trucks. Some biggies that really, over here, I'm looking on this side on the left, some really significant numbers that really surprised the market. And we saw, yesterday a big move up in the markets, but then sort of a bleed down as we went into the close. But ultimately, relatively strong day on CPI. And the reason for that is that, it's an indication that the Fed may not decide to continue on its rate hike cycle like we're all thinking. What were your thoughts on CPI?
Well, it was good. I'm glad that we're seeing some lowering of some numbers. 7.1 is still a long ways from 2, which is where Jay Powell said again today, that's the Fed's target. But the other thing that I'm still just skeptical about the CPI report, because a lot of that pressure down came from gasoline. And you've got to be honest right now. Is the market that we're seeing in gasoline a true market? I mean, we're bleeding the Strategic Petroleum Reserve at a record rate right now, so the Biden and co. can save face and lower gas prices for everybody. And is it actually economic in nature? Is it political in nature? I think we all both know that it's the latter, but regardless, it is helping. The decrease in gasoline is helping, but how long is that going to last? Are we going to see oil prices stay down here, especially if we don't go into recession? If we don't go into recession, we are artificially lowering the price of oil right now, which will then put pressure back to the upside. So I'm still a skeptic that it's coming down as fast as the market wants it to. I know the stock market, the S&P really wants inflation to come down, but I'm still skeptical that it's going to come down much faster than they think it is.
So yesterday there was a tweet from an economist, Marco Begovic. I apologize if I'm pronouncing his name wrong. And this was picked up by some of the different news services. One of the newsletters that we publish commented on this, that this was the second better than expected CPI report in a row. And this one, the last time that we've had this happen was October 2018. And he goes in, and if you look at some of instead of looking year over year, month to month, but you go back a little bit, he's making the argument that we might be close to the 2% level if you read this tweet. So if you do some normalizations and look at different periods, so it was definitely a very positive sort of, I'm an optimist, right? So sort of post, and I lean that way. And I did see some other stuff yesterday. Merrill Lynch has, and yes, there is still stuff being published by Merrill Lynch. Their chief investment officer posted their forecast for 2023. And, the opening paragraph is that we might surprise everybody and get inflation under control quicker than everybody is thinking. And I don't know if that report was written after the CPI report is released around the same time, but I think the CPI report was an indication that whether you give credit to the Fed or not, I think inflation is coming under control quicker than we'd expect. But everything changed today, right?
Yeah, I think, when Jay Powell took the stage today, I think there was a handful of people that were hoping that he would, in fact, even raise only a quarter of a point and indicate that they're going to be done at the terminal rate of 4.5, maybe 4 3/4. And I think he was pretty clear in his meeting today. First of all, they raised a 0.5 point, but they also was very clear that 2% is their target and that they see it sticky, that they see it being here for a while. Because of what he referenced was wage pressure and the strong job market once again, that he doesn't think that they can control it until they start to see some weakness in the employment market, which maybe they can, maybe they can't. We'll see. I have to agree that there are parts of the economy that I do see inflation coming down. I think the used vehicle market is particularly one of them that's really arguably a bubble is imploding right now. That I referenced it at our summit in Las Vegas about my used vehicle that I own being, just a year ago. It's a 2019. I bought it new, and I bought it new for $60,000. And a year ago, I could have sold that vehicle for $80,000. Being 2 years old, and that bubble is popping, and it's going down 2 to 4% a month right now. Used cars are the latest I was reading, and so that part of the inflationary package is going to continue to show weakness. We know the housing sector is going to show weakness eventually, because that's another sector that's really getting hit very hard right now. But that one's a very lagging one. I know we've talked about that in the past. That rent of shelter number is a very slow one to show decreases. And so, yeah, you can see that number down 2.9% on used cars and trucks. Yeah, that's a pretty big one.
It's huge. And gasoline down 2%. These are two of the biggest components, and they make sense logically how gasoline and vehicle costs tie directly to transportation costs, which affects so many other commodities. So food and everything else that's all affected by those numbers. Of course, I don't think diesel went down, did it?
No. Diesel's at like $6 a gallon now.
You drive diesel, so
I do drive diesel.
Maybe the Elon Musk semi will address the cost of the fuel costs.
Well, like I say, I think there are some positive trends that we are seeing. At least inflation's not climbing anymore here in the US. And we're seeing some lower pressure there. But at the same time, I'm not I'm not of the opinion that the Fed is going to be done at the terminal rate of 5.25 and or even 4.5. I think 5.25 might be a closer hope that they might be done. I read a report from the analyst from Morgan Stanley yesterday, or maybe it was Goldman Sachs. It was one that you forwarded me, talking about what if the Fed had to raise rates to 7%?
Oh yeah, I saw that.
What would that do? And it's not out of the question. I think the market wants to jump ahead and say we've solved inflation. Let's move on to the pivot and the rate cutting again. And I just don't know that we're there yet. And I think that's what Fed Chair Powell said today. And I think that's why the market decided to sell off today after it had been rallying in anticipation of the meeting, both yesterday and today.
Let me pull up the CME market, CME FedWatch tool here, and share some data there. So this is the update for February. We just had the December meeting, so that month's gone. What's amazing to me is that there's a huge shift to a 25-point basis hike, or 25 to 50. So just yesterday, the probability of we rose to 375, 400. That's what was announced today.
Yeah.
Yesterday, the probability of a 25-point basis hike was 0. It's been 0 for a long time. If we hit the compare, we can see that just these are going back a day, a week, and a month ago. This is where the market was forecasting. We definitely have a more dovish forecast. Still raising a 1/4 point is, which I think that's perfect. I think that's the sweet spot. I think if we go to 0, people might freak out a little bit. I think when the Fed ultimately goes to 0, we probably could get, it could be a negative reaction in the market because people will think it's because, the economy is doing poorly. So the fact that the Fed is going to still continue to raise rate is an indication that things are solid and things are good. We continue to have, some good numbers, and certainly unemployment is doing very well. So I would think objectively, if I saw these numbers that we see right here, and you asked me what the market did, I think if you asked anybody, they would say the market went up. And that's not what happened today. The market, made an initial reaction down within seconds of the press release. So it was all, I guess, technically there are people who get copies of the report ahead of time and it's embargoed. But unlike the CPI report, did you hear about that yesterday? That the market moved about a half an hour, 30 minutes before the CPI report was released. There was a very sharp move down. So
what? No, they didn't. They did not trade on insider information.
That was yesterday. But yeah, what are you going to do about that? But I think this is a good sign here. The other thing that was released, so every couple of months, or is it once a quarter, they do the summary of economic projections. So the last time they did it, yes, every 3 months is the summary of economic projections. So the Fed presidents and the Federal Open Market Committee, everybody, there's 19 participants that are all senior executives of the Fed, and they have their teams get together with their vice presidents or researchers and their staffs, and they come up with forecasts of some important economic indicators. So they look at GDP, unemployment rate, PC inflation, core inflation, and projections of the Fed funds rate. And this is what moved the market. I think this is why the market went down, is that the unemployment rate, the forecasts have gone up by 0.1 to 0.2 points. They're looking at 25 is when things are going to come down, but we were 4.6 for next year. This is the end of the year. We were at 4.4 in September. We raised it to 4.6. And PCE inflation, we were at 2.8, and now we're saying it's going to be 3.1. Core was 3.1 and 3.5, and then the Fed funds rate was huge. So we're looking at the end of 23. The summary of economic projections had it at 4.6, and just today they're saying 5.1. That's not a surprise when we go to the CME FedWatch tool and look at the probabilities here. The terminal rate now is forecasted to be, and this was interesting to watch during the day. I'm not going to talk about how it all moved around, but it sure did bounce around a lot today. But we're looking at 4.25. Actually, is that what that says? Because it was last time I looked at it was higher than that. Let me refresh this page. Probabilities. Yeah. So 4.25, 450. That's crazy.
See, this is where I think the market is way underestimating how far the Fed is going to have to go.
Well, that changed today. It was actually much higher earlier in the day when I was looking at it. That's why I was preparing for this. And like, no, those numbers, it was in the 5s earlier today.
Yeah, I think you've got some speculative money right now betting that the Fed is going to pivot sooner than later. And maybe it's the people who are skeptical saying they think that we're actually heading into a really hard landing type of recession, and that they think the Fed's going to have to start cutting rates really soon to keep us from going into a really deep recession. I'm not in that camp yet. I actually still think the economy is pretty strong, and it's mostly based on the job market that it's pretty strong still. And so for me, I guess I'm going to keep following Jay Powell on this. And if he doesn't change his tone, I don't even know if they end at 5-1. I think, I was listening to, there was a guy they had, and I was driving around during the Fed meeting. I actually like to do that because I can actually concentrate better when I'm just
distracted by.
Yeah, when I'm just listening to it. It's me controlling my ADHD. But anyway, so I'm listening to Jay Powell speak, and I was listening to it, and I happened to be listening to it on CNBC, and they brought in, I'm trying to remember who it was afterwards to interview. I want to say it was Michigan, a former Fed governor. And he basically said the same thing that I believe, in that the Fed is going to have to keep going. They're not going to be what the market thinks. That this, and you're referencing the CME tool, the market believes that they're going to raise 50 basis points, which they just did, and then they think they might do 1 or 2 25-point cut or rates, and then they think they're going to start cutting by the end of the next year. And Michigan basically said, he's like, I disagree. He's like, I believe that the Federal Reserve, the FOMC, is going to continue to raise rates, albeit at a slower rate. He's like, I think they'll slow down to just 25 basis point increases, but he thinks it's going to be ongoing through next year, and that the terminal rate could end up being much higher than what the market is predicting right now. And that's, I guess, what's one of the big questions in the market right now is which path, because if the Fed is, 1 or 2 more increases and then they're done, and then their next steps are potential cutting, I think we could be off to the races bullishly, the S&P wise. I just don't believe we're there. I think we've got more interest rate increases than what the market has priced in.
Well, let me pull up I want to pull up an intraday chart. I meant to do that earlier. So here's an intraday chart, 1-day chart. So here's where the press release came out at 2 p.m. and went down, and then the press conference started, and it went down and more because Powell opened his mouth, and then there's some positive comments. Apparently, I don't know. Some of this is maybe just volatility. This is going back. Here we are looking at 2 days. This is a 5-day intraday chart, and yesterday was the CPI report. If you looked at pre-market, there was actually a big gap up that I talked about before the press release of CPI. I guess we're better than we were on Friday. So
yes, we are.
Even as bearish as it felt today, frankly I'm surprised. I think objectively, I'm not sure that I totally agree with you, Greg. I think objectively, if I looked at what I saw with CPI, it doesn't match up with the report. I agree. This CPI number I think was fantastic. The summary of economic projections that gets provided by the Federal Reserve, they work on it for 3 months. And like I said, these committees get together, put the thing together, and then hours before the press, so literally 24 hours, or I guess 26 hours before Jay Powell's press release, because this question came up in the press conference. I don't know if you hear it, but somebody asked him, like, did you see the CPI print? Because it doesn't seem to line up with what's in the summary of economic projections. And he said yes. And did people have the opportunity to revise their forecast? Yeah, I'm telling you, there's no way that the committees, that each one of these is going to, I do not believe the CPI number from yesterday is in the forecast. And I think that if we see more numbers like this over the next couple months, I think we are off to the races, because my sense and is that inflation is, and you talked about some of the key points. I think inflation is under control. I don't know if we're agreeing or disagreeing here.
No, we're disagreeing.
We're disagreeing.
It's all right though.
No,
we're
I think
disagreeing.
that's great.
Here's why I don't think.
But you're wrong.
Here's why I don't think inflation's under control, and that's okay. I think it's done rising, but I don't think it's going to lower anytime soon. Well, unless we're going to drain the Strategic Petroleum Reserve. That's the manipulated market, I think, right now, that I don't think is real. I don't think $3 gasoline is a real number. I think that's the manipulated market right now. And if the federal government steps away from the SPR spigot and shuts it off, I think gas prices go back up again, and we see inflation push back higher with that level of gasoline. I think
we had a 52-week. Was it a 52-week low?
Yeah, pretty close to that.
Pretty darn close to a 52-week low last week in crude oil.
And again, that's a manipulated market lower right now. I don't think it should be that low unless we stop, tapping in the SPR, which eventually we'll have to stop, because eventually it will go empty. They can't do it indefinitely. So let me read a tweet. I don't know if you looked it up yet or not, but Bill Ackman, love him or hate him, he manages billions of dollars. He's a pretty brilliant guy. Now, he may be a manipulative guy, but he made this point today on Twitter about an hour ago, actually. He said the Federal Reserve's 2% inflation target is no longer credible. Deglobalization, the transition to alternative energy, the need to pay workers more, lower risk, shorter supply chains are all inflationary. The Fed cannot change its target now, but will likely do so in the future. When asked, Powell recommitted to that 2% target, but admitted that examining a higher rate was possible longer-term project. Businesses need price stability, but can thrive in a world with 3% stable inflation. I don't think the Fed can get inflation back to 2% without a deep, job-destroying recession. Even if it gets back to 2%, it won't remain stable there for long. Accepting 3+% inflation is a better strategy for a strong economy and job growth over the long term. Now, whether you agree with them or not, it's one of the big questions out there right now about the Fed. And, because I actually have a tendency to agree with him, that I don't think they can get us back to a 2% number without creating a recession. And maybe it's a big job destroying one. Maybe it's not, but I don't think they can get us there. And therefore, I don't know if the markets will be super bullish if that happens. Now, maybe they change. Maybe he's right. Maybe the Fed will come out in, the next 3 to 6 months and say, we're going to actually investigate increasing our target to 3%. Maybe they lose credibility. Maybe that's what the market wants.
Yeah, this 2%, it seems crazy, because over the past decade, we've been all joking about how far under 2% we are. And we've had similar conversations in public that it's like turning the Titanic. You move a little bit, and then the whole thing goes, and then it goes too far and you overcorrect. So that's exactly what we thought was going to happen. I'm with you that it's really difficult to sort of fine tune, but this is by far in my adult life the most anticipated and broadly predicted recession in the world. I mean, everybody,
Yeah.
there's not a person in the world who doesn't know a recession's coming. And I do think that, knowing that it's coming probably makes it a little bit better. Although there was a piece by T.S. Lombard that came out over the weekend that was saying that it's very interesting. The press, the meeting minutes from the Federal Reserve have been private for a long time. Now they're public, but they have been in the process of releasing the old ones after 5 years have gone by. And one of the people there from TS Lombard's gone through and read them all and scraped some of the data on it. And he said that the Fed is remarkably good, actually probably the best forecaster of a recession. If they go back and look at their forecast, which hadn't been made public. So they're forecasting, and he said when the Fed, basically what he said, when the Fed forecasts is that inflation or unemployment is going to go higher, that it's going to be a recession. The other key takeaway is that every single time they forecasted a recession, it was always much worse than they expected. So I know I don't know where we're going to go. I hope it's not worse, but you could be very right that we could have this really bad recession that it is that's we're all hoping doesn't happen. We all think we know how bad it's going to go, but these tend to be non-linear events. So once things start cascading and people start losing their jobs, it affects sentiment of other people and things. People go into turtle mode, stop spending money, and it just cascades through the economy. And we haven't seen a real bad recession like that since 2007 and 8.
Did you see Morgan Stanley, Mike Wilson from Morgan Stanley, his note on Monday this week?
Probably.
That's basically what he said, is what he was echoing, or you're just echoed his comments of, we need to stop focusing on inflation and the Fed because that's yesterday's news right now. He's like, we're in the final stage of this bear market, but the next stage is going to have nothing to do with inflation. It's actually going to have to do with a decline in corporate earnings and the recession that's coming next year. So maybe it's right. Maybe we just saw the last 7 print on inflation we'll ever see, and we're going to be at 2% inflation faster than we know, and all of a sudden we're going to go into deflation faster than we can handle it. That's a possibility.
Yeah, it is possible. I mean, all of those are on the table. It's not a 0% probability. So anyways, I'm surprised by the market. I hope that the market does take the time to put everything in perspective. And, I think what I saw this week was bullish. I think the Fed is a little bit more conservative. I think if the report was released next week, that the result would have been different, that we would have seen a summary of economic. I attribute what happened today in the market due to because the comment was exactly the same. The 50 basis point was exactly what was predicted. The statement didn't change. It's only the summary of economic projections, which is a little bit more hawkish, I think. And I do believe that, we won't see another one for 3 months. So we won't get an opportunity to see that revised, but maybe we'll see. I don't know. We'll see. Well, I don't expect Powell to change his language, but then again, we're going to start back up with Fed speaking next week again, and maybe we get some comments. So Mary Daly is speaking on Friday, and then a bunch of Fed speakers next week. So we'll see how those comments could be market moving.
Hey, I have another question for you. And we didn't prep for this one at all. But it's been in free fall. What are your thoughts on Tesla right now? I know you trade it. I know you.
So I have a put spread that I share with the community. So I sold a put and bought a put. The short put's closer to the money. It's deep in the money. It's way in the money. On this trade, the most that I can lose, I think, is $300, even if I take ownership of shares, as long as that long put's there. So it's a kind of trade with that spread. If it falls, I want it to go way down, because then it'll find a bottom. My theory, and I have been following Elon Musk, a big fan. I read him on Twitter. He has been out of control, and the stuff he's done over the weekend is just really some of the craziest stuff he's done. He's tweeting stuff about Fauci, which is, it's got half of America really, really upset, and some other things too. Okay, so let's back up. When he was selling shares, Tesla was dropping, crashing. And then all of a sudden these Form 4s come out and we find out that he had been selling for 3 weeks. We don't find out until, I forget what the period is later, 2 weeks or 3 weeks, whatever the reporting period was. But we found out that he had been selling consistently, and all these day after day, another Form 4 came out and we found out that he had been selling. People on Twitter asked him, "Are you done selling?" And he said, "Yeah, I'm done." And then a few weeks later, more Form 4 start coming out, and we find out that he's still selling. And people on Twitter said, "Hey, what the heck?" And he said, "What? I didn't know I was going to get the financing to buy Twitter, and I need the money, and I don't want the deal to fall through, and or whatever." So somebody asked him, I think it might have been Sawyer Merritt or somebody that he responds to, asked, if you sold too much Tesla, will you buy it back? And I believe there's a good chance that he's intentionally trying to drive the shares down to buy them lower price. I would not be surprised if we find out in a few weeks that he's been back in buying shares, and does raise the bell about market manipulation and things like that. And we'll see, he'll fight his battles with the SEC on that, if that's what did in fact happen. But he posted a picture that was just the NPV calculation, net present value calculation, which is, and he's commented twice, 2 tweets about shareholder value and his commitment to shareholder value, and that Twitter will ultimately be a net positive for Tesla. So we'll see how it all plays out. But I wouldn't be surprised if we find out in a few weeks that he's been buying shares. So I think fundamentally, if you look at future forward PE, it's never been lower. And the company makes products, they do well. I think it's, with protection, caution, I think we're near a place where you need to start looking at buying it.
That's kind of what I was thinking as well. I mean, that's why I wanted to get your opinion. You've traded it and follow it forever. And to me, it's more entertaining.
It is definitely entertaining. It's a fun one to watch.
It's not just entertaining what he's doing on Twitter. It's actually, I think, some important discourse that has to happen. Whether he's going about it the right way or not is another question. But I think he's trying to make there be less division than more division. I do think that's his goal with what he's doing with acquiring Twitter, and trying to create a platform that seems more fair. I know the left really hates him right now, but I can tell you from the right, and I say this because I'm with you. You and I are both, we're not left or right. I'm a libertarian right there with
That's
you.
it. Yeah.
But to me, that I think before he bought Twitter, the right had given up on social media completely, of feeling like we can't talk on social media anymore. It's all controlled by the left side of the political aisle. So I think he's trying to bring it back into balance, and trying. Whether it ends up that way will be another interesting discussion. But yeah, it was really interesting to see. I know you follow him. I don't necessarily follow him, but I read his stuff from time to time. Ross Gerber, has been pretty vocal about kind of removing Elon as the CEO of Tesla right now. And I'm like, wow, that's interesting. But
that's, Tesla just had a big release of software with all kinds of cool features. It's, if you have a Tesla, you basically have a PS4 now. I don't know if you saw that about all the Steam.
I did. Yeah.
You can play Cyberpunk in your computer.
Yep.
With awesome sound system. So people are, I don't want to sit in supercharge. Like, there's been times when I'm sitting at the supercharger where I don't want to go. And like I'm in the middle of watching Netflix or playing a game or something, and it's a lot of fun to be in. So it's it's a big software release, got a lot of people excited about it. And he made the comment that SpaceX and Tesla have enough good leadership that those companies can run on their own. I don't know. I'm a little bit concerned about dilution too. But then again, Jack was able to measure, Jack was able to manage 2 companies at the same time too. He was was he CEO of Stripe and also
Yeah, Stripe and Twitter at the same time.
Stripe and Twitter at the same time. So yeah, Twitter's got its issues. It's fun to watch. It's an evolving, interesting.
Yeah, for sure.
I think we'll see where it goes. I kind of wish I could trade Twitter, but maybe someday it'll come back as a publicly traded company.
We'll see. All right. Well, it's been a pleasure.
Good to see you.
Those of you who listened all the way to the end, don't forget to like and subscribe. Thanks for joining us.
All right. Thanks, everybody. Bye.